Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening to all the viewers of All England Good Night. Hello, I'm securities analyst Yuren Cheng. We're getting ready for the new year next week, so I'd like to wish everyone an early Happy New Year in advance. And starting tomorrow, we'll be entering our New Year live broadcast phase. So basically, from tomorrow until next week, most of the time we won't be appearing on camera, showing our faces, but for the most part, we'll still be providing related services for everyone. For example, tomorrow we will be in charge of the live broadcast, and next week, on New Year's Eve, Monday is Martin Luther King Jr. Day, so we'll be taking a break that day. Then on Tuesday, the first day of the Lunar New Year, I'll continue with the live broadcast, and after that, on Wednesday and Thursday, Peng Lei will be providing everyone with some discussions about individual stocks. Then on Friday, we'll return to having Brother Zhang, that is, Teacher Zhang Jida, provide the service for everyone. So this is just a heads up in advance to let everyone know about our arrangements for the upcoming New Year holiday. Alright, let's talk about this now. Basically, after the non-farm payroll numbers came out yesterday, the overall expectation for interest rate cuts has definitely been pushed back significantly. But whether that's actually good or bad, we're not really sure, because the data that came out yesterday was honestly really impressive. And with such strong data, it basically ties into a second point. Commodity stocks, as well as some of the transportation stocks we've seen recently, or the industrial stocks we'll be discussing tomorrow, or stocks that are sensitive to inflation, all of these are actually closely related. Because if the overall economy is actually heading toward a real economic recovery, then basically it's more likely that we'll see a situation where all sectors are thriving together. So that means commodities could strengthen, and all the related industrial indexes and individual industrial stocks would also perform well, and global stock markets could also show relatively strong performance. So this is just something for everyone to keep in mind as a reference. Next, I want to talk about how even though expectations for interest rate cuts have been pushed back, there's a possibility that some banking regulations might be loosened. This isn't about the actual content of the rules themselves, but more about a shift in attitude. Whether the Fed will adopt a more relaxed approach to overall banking supervision could be an important direction for us to watch going forward. Alright, let's first take a look at some pre-market news. First, I want to talk about Europe, mainly because Germany has actually been making further progress this year, especially in terms of defense spending and military procurement. But now, there are concerns about whether these contractors might be working with China or even the United States. I'm not sure, but they even mention the US, which is actually pretty interesting. Basically, what they want is for their domestic defense contractors, like Rheinmetall and other companies, to rely entirely on European suppliers and the European supply chain, instead of depending on supply chains from China or the United States. So this is actually pretty unique. If this policy is really put into practice, it will have a very strong boosting effect on all of Europe's manufacturing industries. Next, regarding the US and Japan, although the details of the investments are almost finalized, the main projects will likely include SoftBank's data centers, deep-sea oil drilling in the Gulf of Mexico, and another project related to semiconductors. Alright, and then at 9:30, the number of people filing for initial unemployment benefits will be released. The market currently estimates it at 223,000. And then, let's see how things look in the pre-market. If pre-market trading isn't much affected, I might just skip looking at this data altogether. Alright, let me show you the interest rate cut expectations. Actually, yesterday there was a pretty noticeable drop. Previously, it was around 0.6. At one point, the market even reached 0.6, but now it's pulled back again to about 0.5. So basically, it went from possibly expecting a rate cut of more than 50 basis points, maybe even 75, and now it's back to around 50 basis points. So the expectations for a rate cut have indeed declined, because basically the data released yesterday, as we talked about with everyone, whether it was Hack or Logan who spoke yesterday and the day before, they're both really focused on the overall job market. As long as the job market doesn't weaken, basically they're not really considering taking action to cut rates. Alright, basically this official, Schmidt, is saying the same thing. He believes that right now we're still maintaining a moderately restrictive level, and inflation is still something to be concerned about. And then, as long as the overall economy doesn't come under pressure, then it's fine. It's fine. Honestly, if you put it plainly, what he's really saying is that as long as the job market looks stable, then basically keeping the current interest rates as they are isn't really an inappropriate move at all. So basically, like we talked about yesterday, Bernberg is forecasting that, well, even though the downward revision is pretty significant, about 900,000 people, it still doesn't seem too bad. That's why Bernberg still insists that there should be a bigger rate cut this year. But overall, it looks like the entire job market is still maintaining a moderate growth trend. So for the Fed, unless the CPI, which is going to be released tomorrow, shows a much more significant drop, they actually won't actively consider cutting rates. So like what Milan said yesterday, Milan said, hey, the employment data is really good, the economy is great, but we still need to cut rates. Actually, he insists on rate cuts, which is exactly the same as what Trump said. Trump also said, oh, the job market is fantastic, the US economy is amazing, and the stock market keeps hitting new highs, but still, we need to cut rates. So basically, everything comes back to inflation. As long as there's a more obvious drop in inflation, rate cuts should still be the main theme. Now, this brings us back to US politics, because basically the latest development is that the US House of Representatives has actually taken a strong stance against things like tariffs on Canada. Their vote was very much opposed, and you could even say they want to outright veto this issue. But because this bill has to go to the president, Trump has directly said he might veto it. So now we're waiting to see if he actually will, since he said he would veto it about a month ago. Now that the vote has really happened, we'll see what he does. The Senate vetoed these tariffs, and the House also vetoed these tariffs. So will Trump veto their veto? This is probably something we'll have to watch over the next few days. As long as he vetoes it too, then it's just a purely political statement. But if Trump quietly accepts it, then it means the issue of tariffs might not need to go all the way to the Supreme Court. Congress could just take back the power themselves. And as for tariffs, I have to say, inflation will definitely go down. Because inflation right now is all one-off, and tariffs are a one-time inflationary factor too. That means once tariffs are removed, it'll be a one-time factor causing inflation to drop. So in the next few months, inflation will decrease quite a bit, which will be a positive for future interest rate cuts. So it really depends on what Trump chooses to do, whether he wants to save face and veto their veto, which could keep inflation from dropping quickly, or if he wants to win votes and just go along with the veto, accept it, let inflation fall, and as a result, bring down overall interest rates. Next, it all comes down to what Trump will actually do and how he'll weigh his options. So we'll just have to wait and see. Because if he does accept it, that would be a huge positive. I have to say, it would be an enormous boost, a super bullish signal for all stocks. Alright, and then here, Schumer also directly mentioned that while AI might increase productivity, the US hasn't reached that stage yet. Alright, even so, the economy is doing really well. There hasn't been a rate cut, but the regulations are actually about to be loosened. The latest development mainly comes from Bowman. Bowman has sent a very strong signal that overall regulatory measures are going to be relaxed. In fact, he directly stated that there are plans to cancel some of the previously issued non-public corrective warnings. To put it in plain language, it means they're going to cancel all the warning letters that were sent out before. Basically, all the things they previously asked you to fix, you don't have to fix anymore. And all the requirements they made before, you don't have to do them either. In short, they're relaxing all the regulations. To put it bluntly, this is actually a very strong move to loosen regulations, because it's like, if we compare it to Taiwan, it would be as if our regulatory authorities stopped constantly monitoring banks and securities firms, stopped writing official documents all day long. Basically, they just stopped doing that altogether. And once the Fed stops doing this, it actually gives all the banks much more flexibility in their operations when it comes to lending, issuing loans, and other activities, managing their balance sheets or interacting with clients. They can all be handled with more autonomy. Liquidity can be released more boldly as well. So overall, this is actually a good thing for the market. He's saying that now. The main focus should be on the immediate risks to financial health, rather than just on procedures and processes. Because in the past, it was all about procedures and processes. They really cared about those. There was a lot of regulation, and previously, they were extremely concerned about this. They believed that the cleaner your rules were, the fewer flaws there were in your rules, the less likely you were to make wrong decisions. So logically, there's nothing wrong with this approach. But when it comes to actually putting it into practice, JP Morgan basically said, why bother with extra trouble? Instead of letting you nitpick our processes and procedures, we'd rather just not do it at all. If we don't do it, there won't be any problems, right? But the result of not doing it is that a lot of excess liquidity ends up completely locked on the bank's own books. So once these procedural requirements are gradually relaxed, it's actually a huge positive for the entire economic system, especially for the real economy. Because actually, a lot of the liquidity currently stuck in the banks doesn't necessarily flow into the stock market, but where might it go? It flows into the real economy. Next, they need to make adjustments to what they call needs attention and needs immediate attention categories. Right now, everything is basically on hold. They'll only issue requirements if something really major happens or if a problem absolutely has to be fixed immediately. Otherwise, they might not issue any requirements at all. And in addition, even their memos, originally when they looked into the memos, it was all about focusing on issues that pose substantial financial risks to the safety and soundness of banks in order to improve regulatory effectiveness. This whole long statement basically means that as long as there isn't any substantial financial risk, they won't get involved. They just won't bother. So given the current strict internal controls and regulations within banks themselves, as well as the bank's own expectations for their future and all the various requirements from the past, whether it's Basel III or Basel II, Basel III, all sorts of requirements, plus the additional buffer space they have, basically it's highly unlikely that banks would put themselves in a position of substantial financial risk. They're just not likely to let themselves get into that situation. So in effect, overall, the Fed just won't intervene. If this is really put into practice, it means the Fed just won't get involved anymore. So for banks, this basically means they'll feel even more confident to expand their business operations aggressively. This is a very, very strong positive for the real economy. Also, they're saying that if the Fed really does want to set requirements, the language needs to be plain and specific enough. So looking at it from another angle, it used to be that banks preferred to avoid trouble, but in the future, it might be the Fed itself that decides it's better to avoid unnecessary hassle. Since it's such a hassle, they might just stop issuing warnings altogether. As long as nothing looks like it could cause a major problem, they won't bother warning anyone. So basically, this means they'll completely relax the entire regulatory environment for banks. A total relaxation like this is actually a really good situation for all businesses, especially those that need to borrow money. And in the future, the focus will pretty much be on substantive issues. Only really serious matters will be addressed. As for other things like compliance and such, they won't be particularly strict about those anymore. And some existing cases might just be dropped altogether. They could all be canceled directly. So what kind of good news does this bring? Who will this have a major impact on? The real economy? So looking at things right now, the economy actually seems to be doing pretty well. Because really, if you've been following the US for a long time, or if you've listened to our Good Night Show or to Mr. Fan's Good Morning Show in the past, longtime listeners probably all know one thing. When it comes to gauging the US economy, a very important core indicator is US trucking. The mileage of US trucks, the demand for US trucks, and anything related to US trucking are all extremely important indicators to watch. Once the overall trend for US trucking is upward, especially if you pay attention to the so-called Dow Jones Transportation Index, that's actually another very key indicator, though that one tracks stock prices. If we look at the real physical economy, then we're looking at the actual condition of the trucks themselves. If I look at the overall trucking demand, in the past few weeks it has surged significantly. The rate of this increase is basically no different from what we saw around this time in 2020. It really is basically the same. So in a way, doesn't this suggest that the real domestic economy in the US is actually booming? In fact, it's performing extremely well. So looking at yesterday's non-farm payroll data, hey, it's possible that the overall situation in 2026 might actually be pretty good. If we also consider what we talked about yesterday, Bernberg's own estimates, actually the overall condition of businesses is improving and business survival rates are also rising. Is it possible that 2026 itself? What kind of year will it be? That year could be a year when the real economy in the US is booming, which means that all the stocks related to a thriving real economy might be even more resilient. And in this kind of situation, is it possible that the US dollar could weaken? A weaker US dollar is actually a good thing for America's real industries. And at the same time, a weaker dollar could mean that commodities and raw materials might perform well, and global stock markets could also do well. So if all these things come together, because right now we are indeed seeing this kind of capital flow, and we can also see this situation happening in the US real economy. Because if you pay attention, basically every time the US real economy is strong, there's always one thing in common. The US dollar is weak. Usually it's a period of dollar weakness, almost always. So in a way, isn't this also an early sign that the dollar's weakness is more likely to be a long-term trend? So in this way, it basically corresponds to the US stock market, meaning that these real economy related US stocks might also become even stronger. So then who exactly does this benefit? It could be the small and mid-cap industrial stocks, maybe the Dow Jones, maybe the S&P 500, and not necessarily the high momentum tech stocks that have been booming in recent years. Not necessarily. They might still go up, but the gains will probably be weaker compared to the ones I just mentioned. So I think this is a trend that could very well happen. All right, that's the situation with truck demand. Now let's look at the next thing, freight volume. Since demand is strong, how is the situation with freight capacity? Right now, it looks like freight capacity is about to hit a record high. The volume that trucks are carrying is basically set to reach an all-time high. So what's causing this? I actually looked into it a bit today, and there are a few reasons. First, a lot of trucking companies went out of business last year. A whole bunch of small and medium-sized trucking companies shut down completely. So now the supply and demand for trucks is out of balance with a serious shortage on the supply side. But what about demand? Demand has actually risen sharply. Steel and related construction materials, infrastructure demand, things like cement and rebar for infrastructure, all of that is going up. Machinery and equipment demand is also rising, and so is the demand for chemicals. All of these are pretty heavy items, so this has led to an overall increase in freight loads. The last time we saw such a sharp increase was around 2020, which was mainly driven by huge demand for electronics and consumer electronics. But this time, it looks like the demand is coming more from infrastructure projects. So when was the last time we saw such a big surge in infrastructure-related demand? It was 2006 and 2007. That was the last time, right? So is it possible that this time, just like back in 2006, 2007, and 2008, when the US real economy was booming, we might be seeing a similar situation now? I think this is just something for everyone to keep in mind as a reference. And then another thing is that transportation between the US and Mexico has also seen a significant surge. So right now, it looks like the demand for all basic raw materials, especially for trucks, is extremely strong. And as you all have probably noticed, recently in the global market, whether it's raw material prices in China or the situation in Japan, basically even the most basic raw materials for electronics are all going up in price. Everyone is raising prices. So is it possible that this year could be a year of explosive growth for the more core, more fundamental industries? I think this is something for everyone to keep in mind. Because if this turns out to be true, then this year's investment strategy will have to be completely different from last year's. It'll require a totally different approach. So this is just a direction for everyone to consider as a reference. Alright, so raw material stocks could very well be some of the biggest beneficiaries of this trend. And as you can see here, I'm looking at year to date, the strongest and the weakest performers. Even the weakest ones have a 5.99% gain this year. So basically, among all the raw material stocks, there are no weak performers this year. No one has had a weak increase. So is it possible that this really is their big year? And if we combine this with what I shared with everyone on Monday, actually, when it comes to raw material stocks, once they're above the annual moving average and start trending in a bullish pattern, and then you add in the fundamentals and the overall economic development I just mentioned, isn't it possible that this really is the year for a major rally in raw material stocks? So that's why does my headline mention a big cycle? Actually, looking at things right now, raw material stocks, infrastructure stocks, or related stocks, or even industrial stocks could very well be entering a major cycle this year. I think the likelihood of that happening is definitely on the rise. And it's only February 12th right now, so I really think there's still plenty of time for everyone to make the necessary allocations. It's definitely not too late, and you can still make any adjustments you feel are appropriate. All right, so today we're actually not going to, everything really is going up. Everyone's stocks are rising. Trucking stocks are definitely on the rise, and airline stocks are climbing too. Honestly, all the transportation stocks are going up across the board. And this actually ties back to what I just mentioned, everyone. The demand might really be that strong. And if this chart is accurate, if the trends shown here is real, then from here on out, it's basically an open book. I'll just say it straight. It's like an open book now. What we're seeing now is similar to the early part of 2021. We're probably at a stage that corresponds to the early part of 2021. So how did things play out in 2021? Now, let's go back and look at the textbooks from that time. Let's review what was happening back then as the foundation, and then look again to see if the fundamentals of the company are also improving. If things are indeed improving, then maybe we can just copy what happened in 2021. Maybe copying the playbook from 2021 would actually be the fastest way forward. So this is just something for everyone to use as a reference. All right, moving on. I'm not going to cover all the raw material stocks today. I'll just talk about a few of the main ones up front, as well as some of the more representative ones to discuss with everyone. Take peaches, for example. Over the long term, they're actually really weak. They're basically just chemicals. And when it comes to chemicals, like Germany's BASF, they've also been weak for a long time. Why is that? The main reason is that they used to have a very important buyer. The Chinese market hasn't been doing well in recent years, and the US market hasn't been good either. In fact, globally, the chemical industry hasn't been doing well for anyone, except for those selling chemicals used in semiconductors and some chemicals related to semiconductor etching and lithography. Except for those whose business is doing really well, most regular industrial chemicals have basically been struggling, and that's not even mentioning things like rubber, textiles, or leather. None of those sectors are doing well at all. Basically, in the past few years, no one has really been doing well, not even in Taiwan. But then, well, if you look at their latest financial report, yeah, you can see the numbers are pretty average. There's nothing particularly impressive or surprising about them. In their financial disclosures and earnings calls, they keep mentioning that this year they saved $400 million, which is even more than the $300 million they originally planned to save. And they say that their structural reforms should bring in $500 million in benefits by 2026. What's up? There's really nothing noteworthy. Seriously, their fourth quarter financial report is just lackluster. There's really nothing that stands out. But as for its future growth, the market's current expectations are that its revenue should rebound from the bottom and basically stop declining, which means it should start growing again. So right now, there's this sense that people are trading it as a turnaround stock. And overall, both EPS and net profit should have a chance to turn from loss to profit, since the current estimates are still pretty pessimistic. If things really follow the big trend I just mentioned this year, it's possible that losses could turn into profits this year. Anyone who's been following stocks or investing for a while should already know this. Turning losses into profits brings the strongest momentum. It absolutely brings the most powerful boost. Even though it's not as strong as it was a few years ago, this shift from loss to profit really does improve momentum. Plus, it's a stock with a low price-to-book ratio. Profits have turned from losses to gains again. This could be the direction the market currently favors. Low price-to-book ratio, and the company itself is showing a turnaround, moving from losses to profits. So it might not necessarily reach its historical highs, but at the very least, there's a possibility for a turnaround. Alright, and here's something for everyone to use as a reference. If you look at the yearly chart, basically it has already crossed the annual moving average. Overall, both the short-term and medium-term moving averages have already crossed above the annual average. So let's see if there's an opportunity here. My suggestion for anyone looking to make a move is that it's unlikely the price will just shoot straight up. It will probably go through a period of volatility and pullbacks, then gradually move upward. I would recommend buying in during those pullbacks. And as for your position size, you can go a bit bigger here. For example, if you plan to invest, say, 5% of your total portfolio out of 100%, then maybe you could put about 3% in during the first pullback, and then when it breaks out, you can put in the remaining 2%. I would suggest using an approach like this. If a turnaround does happen here, it could be a right-side rebound. At the very least, we don't know if it will reach a new high, but there is at least some potential for an upward move. And then, moving on, LyondellBasell is basically the same. It's involved in rubber chemicals and fuel oil, and honestly, its performance has been pretty bad over the past few years. Actually, we have similar conglomerates in Taiwan, like the one someone asked me about yesterday, which most people are familiar with. We'll talk about that when we have time. It's just like what we talk about with Taiwanese stocks, but basically, in the US stock market, companies like these are experiencing similar situations, and basically, their fourth quarter financial reports were also pretty lackluster. There really wasn't any particularly good news or major positives. And they're also saying that, hey, in 2026, they could generate an additional $500 million in cash flow. Right now, overall, because the past few years have really been a period of sluggish demand for the petrochemical industry, they've managed to maintain a 95% cash conversion rate. They believe that things won't stay this sluggish in the future, and going forward, their appetite might continue to increase. And overall, from a NAN's perspective, basically, whether it's EPS, revenue, or EBITDA, all of these should start to gradually improve. For example, EPS should hit its lowest point in 2025, and then it will go up year by year after that. And for Aber as well, everything should also increase year by year. EPS is expected to rise every year, so basically, going forward, both the market's forecast and the company's own outlook are for steady annual growth. This is essentially a turnaround opportunity. It's a process of shifting from year-over-year decline to year-over-year growth, and this process itself could lead to an increase in EPS and an improvement in the PE ratio. That's what everyone knows as the Davis double play. And then, if the company itself, well, it also has a low price-to-book ratio, although it's not extremely low, it's 1.9, but compared to the major mainstream countries right now, its price-to-book ratio is relatively low, so capital might have a certain preference or a favor toward it to some extent. It might not necessarily reach a historical high, but it does exist as a potential for growth. Its profitability has basically shown improvement as well. In 2025, its profit margin might even be negative, but by 2026, not only will the profit margin instantly turn positive, it could even be higher than in 2024. It could even be higher than in 2024, and then continue to rise year after year. Both gross margin and profit margin are also increasing annually. With these expectations, investors may actually be more willing to trade it because of this potential. All right, then let's keep going. Compared to the chart I just showed you all, it hasn't reached that kind of breakout bull run yet, so it really does have the potential to be a turnaround stock. My personal suggestion for this one is, well, there's no need to, you don't need to be too aggressive here because you still need to watch the moving averages to see if it can break through smoothly. If it does break through, there will probably be a small pullback, and that's when you can enter. The trading logic is pretty much the same as before. That's because these companies are basically low price to book ratio companies, and they're more like turnaround plays. In this kind of situation, I personally would suggest not being overly aggressive. The reason you don't need to be overly aggressive in trading them is because it's unlikely they'll just suddenly skyrocket all at once. They're not like those high beta, super momentum stocks we've seen in recent years that can jump 10% or 20% in a single day. Instead, they're more likely to move up slowly, maybe 2% in a day, then pull back 1%, and just kind of fluctuate like that, gradually trending upward over time. That's a more likely pattern for these kinds of stocks. And then for international professional, we actually showed you this a few days ago. Basically, it means that in this area, things are generally improving. So, yeah. As for international IP, well, international professional, overall, its revenue, EPS, and EBITDA are all rebounding year by year, showing a trend of steady growth. And as you can see, its EBITDA, it might even reach a new high compared to the past few years. 2026 could set a new record for recent years. So basically, its net profit margin and net profit in this area are likely to keep improving step by step. And its price-to-book ratio is also relatively low. Compared to its own historical averages, it's basically below average as well, so it's in a below-average situation. So it's also a stock with a low price-to-book ratio, and in fact, it really does have some competitive advantages. Back when we talked about it, it was roughly at, it should have been at this candlestick right here where we talked about it. Basically, it has almost completely absorbed the negative news. It's just about fully digested that bad news. So it really is possible that it's forming what in candlestick theory, or from a structural perspective, would be considered a very successful bottom reversal. This can be considered a very successful bottom reversal. So with this bottom reversal here, it's possible that it's forming a right side recovery. Whether it's the start of a new rally is still uncertain, but the possibility of a right side upward movement has definitely appeared. And as for Bauer, this is just for everyone to take a look at, so I won't go into a detailed introduction. Its fundamentals are basically the same. Its earnings, profits, EPS, and revenue have all continued to rise year after year. Alright, and its EPS has basically continued to grow, and its PE and PB ratios are also relatively low. Both are relatively low. Excuse me for a moment. Oh, it's fine. No worries. Just now I thought maybe there was a problem with the live stream, but looking at it, Xiao Wang seems to be fine. All right. And as for its structure, basically, I'd even say it's already showing signs of an initial rebound. Why do I say it's showing an initial rebound? Because it's surpassed this previous high. It's broken past the previous peak. So that means it's already set a new high for this cycle, a new high for the year. So here, it's even more likely to be an initial rebound structure. So on top of that, have you noticed its EPS? Actually, starting from 2023, it's been steadily rising year after year, growing each year. And then, looking ahead, its revenue or its appetite is also growing year by year. So basically, its growth momentum is actually pretty solid. So relatively speaking, its PB, its price to book ratio, is indeed, well, its book value ratio might be a bit high. That's true. But if you look at its PE, it's only 22.4 right now. 22.4 is actually not high compared to the overall market. And it's also not high compared to those really popular large cap stocks at the moment. So its EPS can keep growing, and secondly, I think it definitely has the potential to achieve a Davis double play. This is something for everyone to consider. Next, let's talk about steel. I brought up this company, Tongwei, because it's pretty, well, there's also another one, Pittsburgh. Actually, the strongest ones are Pittsburgh and Dynamic Steel. These two are the main steel stocks worth looking at. For steel stocks, it's the same story. Their EPS has been growing year after year. Its revenue has also been increasing year after year. Of course, not everything grows every single year, but what's even more interesting is its cash flow. Its cash flow has seen significant growth, shifting from a clear and sharp decline to strong, sustained growth. Yeah. Is there any sound? From my system, it looks like there is sound, so if you can hear me, then... Okay, great, the sound is back, the sound is back. Mr. Lin, there was no sound just now when I was talking. 29 minutes. So at 29 minutes, I think I was talking about... Yeah, I think I was talking about this slide, this one right here. So actually, yeah, what I was just saying, I think I was talking about the global situation. I'll just make a guess here, since I mainly focus on Europe myself. And actually, from what I've seen in Europe this year, the demand for infrastructure is really, really strong. The demand in the US economy is still strong. There's demand for factories in the US, and there's also demand for factories in Europe. Meanwhile, in China, there's a need for infrastructure related to the Yarlung-Sangpo River, specifically the Asia hydropower area. And then this year, with the war in Ukraine, is it possible that there will also be another potential source of demand? So basically, right now, there's infrastructure demand all over the world. The question is, will this demand for infrastructure drive up the prices of all raw materials? So as you can see, for example, with US Steel, its performance really hasn't been good for a long time. Really, it hasn't been good. But then, all of a sudden, their cash flow over the next few years is continuously improving. That in itself is a very unusual situation. So is it possible that this is actually a potential opportunity? And if we look at it from a technical chart perspective, since last September, it has clearly entered a bullish trend. So from last September until now, it's already gone up quite a bit. But when it comes to steel stocks, they're basically in a bullish phase right now. Is it possible that this trend could extend to all other related sectors as well? This is definitely something everyone should pay special attention to. And then DuPont is actually also in the chemical industry, and it's related to plastics and chemicals as well. As for its sector, it's already fully in a bullish trend too. Since last September, it has entered a strong bull market. Is it possible that it could also be entering a long-term bullish phase and developing into a long-term upward trend? I think this is definitely a direction everyone should pay special attention to. All right, and as for someone asking me, among the sectors I've introduced these past few days, which one do I feel most optimistic about? Personally, for me, I mentioned before that it's core consumer goods. Then there's energy, and what I shared with everyone today counts as raw materials. Next, tomorrow we'll be talking about industrials. So if I had to rank the sectors that are sensitive to inflation, personally, the one I'm most optimistic about is... my top pick would probably be energy, and my second choice would likely be raw materials. Personally, I'm more optimistic about these two main sectors, but you can't really go all in. Let's put it that way. If you just go all in on a single sector, that's a lot of pressure. So I would suggest diversifying, spreading things out. Maybe you can have a higher proportion in energy, then raw materials and industrials as your second focus, and core consumer goods as your third. That's how I'd set up the allocation. And actually, within raw materials and industrials, you can still make some further adjustments. You can still make some adjustments to the allocation, but I think the overall big trend is pretty much like this. Strictly speaking, I think this year presents an opportunity. It's a year for traditional industries. I believe there's a high chance that this year will be a year for traditional manufacturing and industrial production. So which specific stocks will actually benefit from this trend? Here, I've picked out a few major sectors that I think are likely to see some action. I'll also share some of the subsectors within each one with everyone. This is just for your reference, because honestly, there are quite a few stocks involved. You can do more research on your own and decide which stocks you think might suit you best. So this is really just a suggestion for everyone. I'm trying to help you narrow things down and see if we can identify what could become a major trend this year. All right, and then as for the euro, it's just kind of moving slowly. Right now, it's fluctuating at a high level, moving gradually, and then slowly trending upward. The stock index hit a new high. We just said yesterday that it would probably reach a new high in the next few days, and look, today it already did. Honestly, unless something unexpected happens, it should keep hitting new highs. And as for this area, it's also mostly fluctuating at high levels, just oscillating near the top. All right, let's take a look at the pre-market situation. It doesn't look like there's been any major changes. Alright, circling back, the ones rising the fastest right now are still SanDisk, yeah, it's still the storage sector. For example, actually, all the storage-related stocks around the world, all the related companies, are really strong right now, because honestly, that's just how it is. It's all interconnected. One link depends on another, and if one is missing, eventually the whole supply chain ends up short. That's just the current trend. As things keep getting pushed up, is it possible that the shortage cycle will reach all the way back to the very beginning, to the raw materials and infrastructure? Honestly, everyone is running short on everything. So once this shortage throws the whole process out of balance, the impact it can have is huge. This wave of price increases can really drive up stock prices. It becomes a very powerful force. All right, moving on. As for the US dollar, personally, I still think the dollar will weaken in the long run. It'll probably trend downward gradually, not drop all at once, but just fluctuate and slowly go down. Alright, and as for the 10-year outlook, at the moment, it still looks like things will remain pretty volatile. It's still mostly going to be choppy. Whether it'll really break out and go up significantly, I think in the short term, the moving averages here are probably going to get tangled up for a while, so it's likely we'll see some sideways movement here for a bit. Okay, now let's take a look at the S&P 500. The S&P's pre-market performance is also looking pretty good, so there's actually a chance it could close at a new high today. I think there's definitely a possibility for that today. But as for the Nasdaq, the Nasdaq is still relatively weak. For example, the Nasdaq is definitely on the weaker side compared to the others. But the stocks everyone is most familiar with are still mostly on the Nasdaq, but I don't mean to say it's weak overall. As for the Dow Jones, unless something unexpected happens, it should have a chance to hit another record closing high today. I think that's totally possible, so I hope the indexes themselves will continue to show some divergence. So it really depends on how you adjust your own portfolio. Personally, I would actually suggest that this year might lean more toward traditional industries and industrial production. Well, it's only February right now, so we'll have to see if this year ends up being just like 2024 and 2025, where the gains in the first 6 weeks determine the gains for the whole year. We'll see if that's the case again this year. And right now, it looks like the biggest gains in the first 6 weeks have basically come from the 4 major sovereigns I just mentioned. After that, it's core consumer, then raw materials, followed by energy and industrials. So this is just for your reference. All right, that's all for tonight's equities update. Thanks everyone for watching, and I wish you all the best in your trades. See you tomorrow. Bye-bye. Bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.